This would be essentially my view of the classic late cycle environment that we're in, which putting it back in Jim Meal's framework puts me a little bit, slightly more pessimistic, slightly more in the sugar rush camp. I do think we've had a pause that refreshes. I do agree with that, but some of the conditions that we're seeing are very classic late cycle. Demand is increasing very fast. It's causing some inflationary pressures as capacity nears its limits. We're having some tighter monetary policy, which typically can cause asset prices to fall because their discount rates are going up. And so that's why it's actually not unusual to see at this part of the cycle to see a strong economic environment, but falling asset prices. And so I think there's typically a lot of confusion around why is the market reacting this way when things are pretty good. I think part of what we're seeing right now is actually that classic top in the stock market where you get this surge in earnings, and it's fueled right now by the tax cuts, and that does tend to push the markets up as well. So it's a volatile time, but right now we are seeing a huge surge in earnings. Most of the S&P 500 has reported 2Q at this point, and I think it was earnings per share are up about 30% year over year, and obviously that is fueled by the tax cuts, but it's some of the strongest earnings growth that our economy's ever seen. And if you look at the truckload sector specifically, it's a lower margin business to begin with, so there's more leverage from the tax cuts, but earnings, net income almost doubled year over year in the second quarter. It was up 99% for the 13 public truckload carriers that we track. So it is an extremely strong environment, but a lot of these signs suggest that we were very late in the cycle. So these last two bullets essentially tell you what happens when you go into that down cycle. The higher inflation and interest rates can hurt economic demand and take you through that the recessionary part of the cycle. I don't think we're there yet, but this is sort of the framework that I'm looking at for the truckload sector. So starting here with freight volumes, this is a lot of data on this chart. The ATA load index here goes back from 1996 all the way to 18. The point of this is outside of the late 90s when you saw about 3 years of a strong freight cycle, they typically last about 2 years where you see freight really accelerating. And at the moment, we are about 18 months into this freight cycle. It started improving based on the ATA load index in about mid-2017. It was a little earlier on the cash shipment index, but as you can see on that chart, those cycles tend to last, the up cycles for freight tend to last about 2 years as well. And there's a lot of reasons for that, which we'll talk through a little bit further. But the point here is that freight cycles tend to last 2 to 2.5 years, and we've got roughly 1 year left based on that framework. So here is a look at the trucking industry right now based on our monthly survey of carriers. We have about 50 carriers that we survey each month, and they are telling us that July was a nice uptick from a volume and freight perspective. But if you look at the sort of trend over the last several months, we have seen, pointer up here, we've seen a bit of a slowdown in freight. I mean, these numbers here were post-hurricane, and they were some of the strongest freight readings that we've ever had in the survey, so we are coming off of very strong levels, but we are starting to see a little bit of a slowdown from a volume perspective and a little bit of an acceleration from a capacity perspective where truck production is starting to ramp up. We had a few months of weakness in that reading in the second quarter as the OEMs were having a bit of a difficult time finishing trucks, but that has picked up these last couple of months. I think a lot of those red tag trucks are moving out of the plants, and so we're starting to see that acceleration in capacity. And if you combine those two, we get the supply-demand reading on the bottom left chart, and that has gone from extremely tight, historically tight, to a little bit looser, or a little bit at least moving towards a more balanced truckload capacity environment. We're still at the still pretty tight, but it's gotten a lot looser than it was. We're seeing that also reflected on the load boards. We pay a lot of attention to the DAT data on what's happening on the day-to-day spot market in truckload. I would describe this as the off the boil. I think the decreases that we've seen in the load to truck ratios and just that load posted index are a good bit bigger than you typically see. I mean, if you look at there's usually a negative seasonal trend through the year if you look at just that loads posted index, but we saw basically a 25% drop just in these past couple of weeks. So that's a little concerning, but again, we're coming off of historically really a record environment. So I think we're basically at the early stages where the wave of freight is maybe beginning to crest here. And so there's a lot of information on this slide. We've color-coded it to talk about the positives and negatives. We've talked through a lot of the macros here already. The U.S. consumer is really driving a very strong freight environment, and that is the primary fundamental that I think is going to continue to drive some nice growth. Anecdotally, we've heard the Union Pacific is sold out for peak season on intermodal capacity. They're starting to charge some significant surcharges to move freight this fall. That's shows you the rail network's still very tight, and certainly is a good leading indicator for the next few months. But we also point out the tariff risks here, and I'll have a little bit more on that coming up. But the big thing I want to highlight is actually this last bullet on here that I think makes it difficult to understand exactly what's going on in the truckload market, because about half of it is the private fleets. And while we look at a lot of the driver data, and it looks like we're not hiring as many drivers as we need, I think that's less acute than perhaps it seems, because the private fleets are expanding and they are raising wages, and those are much better jobs. A Walmart truck driving job will pay about $80,000 with good benefits these days, and so that's pulling, I think, from the for-hire market and causing a little bit of imbalance there. But I think that the important point here is that those private fleets are growing pretty quickly at this point, and that's going to take freight out of the for-hire market over the coming quarters. So here's a word scatter from the Federal Register from just a few weeks ago on the $34 billion of tariffs that we put on Chinese goods. And it's about 15 pages of text, so I basically thought that this was a good way to present it. And as you can see, machines and parts and machinery parts are some of the things that just keep coming up. So I think it will have an impact on our business from a production standpoint. In the second half of 2006, which was the only other time that we really exceeded a 350,000 Class 8 production rate for North America, I think we were bringing in a decent number of parts from other parts of the world, namely China, and I don't think that's going to be as easy this time around. I don't think we have the production capacity to get to much higher Class 8 build rates, and I don't think this is going to help. But I'll also point out that if you just read all these words, they're all very much industrial and freight related, and so I do think the tariffs will have an outsized impact on the freight sector relative to the overall economy, because only 12% of our GDP is exported, but I think 15% is imported. So you take that 27 combined, and you think about half the economy is services. I think the majority of freight actually is tied to global trade, and so I think this tariff thing is potentially a bigger deal for the freight market than it is for the economy as a whole. In terms of this is leading into our freight volume forecasting. This is something that we've been working on now for a bit of time, and basically we've got three good factors that I think are going to be the best leading indicators of freight. This one is a pretty short-term factor that we take a look at just the weekly rail volumes of the metals and chemicals subsectors, because those are the inputs to production, and that's both a consumer and an industrial input, and those have been really strong. They're running high single digits right now. This is the dotted line on this chart, and so that is likely to slow down because it's facing tougher comps over the next couple of quarters, but it is still signaling a really strong second half, and supports that comment earlier about Union Pacific, being very tight into peak season. So an important point again is the comps do get tougher because of last year's extraordinary hurricane season, and this year's hurricane forecast is below average. Earlier this year, the forecasters were saying we're going to have another bad hurricane season. That's been revised down to a below average forecast at this point. We've only had a few named storms so far, but I think that's going to be a modest headwind to freight in the coming months. Now, a medium-term factor in terms of forecasting freight is the yield curve, and we've hit on the yield curve a number of times. We've explained it in, I think, all three of the presentations this morning. We think the yield curve is very important for a lot of reasons, and as Jim explained, it is a good leading indicator of banking activity. And actually, there's a really strong 9-month correlation with freight volumes as well. If you look at the ATA truck loadings indexes, they correlate pretty well with a 9-month lead. And therefore, this is actually compressed even further. I think the most recent spread between the 10-year and the 2-year is down to about 20, 25 bips. So one hike in the Fed funds rate could be enough to invert this. And at that point, you can pretty much start the clock. In 12 to 18 months, we think the recession becomes more likely. We're not quite there yet, but I think we are getting close. And the main takeaway from this slide, though, is that this is going to be a headwind for freight volumes next year. Relative to the really strong rates that we are at this year, this is going to drive things a bit slower. Inventory is the other key factor in terms of freight, and this does lead into the e-commerce discussion a bit. On the top left, top left here, we have the just retail sales growth, and that's been kicking along really nicely. It's up about 6 or 7% these last couple of months, and it's been averaging like about 5% this year, which is really strong consumption growth. We just found out that our savings rate's a lot higher than we thought it was, so that's good. And the inventory to sales ratio has been trending down. Now, I don't totally trust the inventory data in the GDP reports because that would argue that that inventory was reduced in the second quarter. I think based on the freight data that we're seeing outpacing some of the consumer sales data, I think it seems to me that there's still some inventory building going on, and I think some companies are probably doing some stocking of safety stocks ahead of tariffs. It's difficult to prove that, but the big point in terms of the inventory outlook is that I think as long as e-commerce continues to increase as a percentage of GDP, which looks like it's just got a long runway to keep doing, retailers are going to be forced to continue to support those sales with ever greater amounts of inventory. So I think that's, on net, a pretty positive factor in the freight outlook. So the grays didn't show up wonderfully on this, but we did a project earlier this year for a large hedge fund who commissioned us to study Amazon's supply chain. And I thought this was pretty fascinating. We're allowed to talk about it, obviously. But the shifts that are happening within its supply chain, basically, they're going from a model where they did a lot of things just through the UPS, FedEx, and the Postal Service, and parcel was really the majority of their spend, to as they build out their network of distribution centers, they're doing a lot more of their inbound logistics themselves in terms of truckload, LTL, and even air and ocean, and they've even acquired a number of airplanes, at least through leases, for their own network. And so that's helping them to accelerate shipping times and get things to consumers faster. And I think that trend is going to not necessarily add any miles to the truckload sector, but increase the quality of the miles. If people want things tomorrow as opposed to next week, the quality of the miles, I think, will go up, and there will be more air and LTL type of moves. But I think it's actually also a positive for the truckload sector, because that pressure on time-definite delivery should lead to higher profitability longer term. Here's one slide very quickly on how that connects into to electrification. We have a lot more in the program today on electrification, so I won't talk much about this. But I'll just make the point that on shorter lengths of haul, electrification makes a lot more sense than on long-haul trucking. And that was one of the outcomes of our electrification study, is that these shorter types of duty cycles are much more conducive to electrification, because obviously you don't need as much battery capacity, and the local start-stop cycle definitely helps the efficiency. So I'll jump forward from there. Here's a really interesting chart, and Kenny will talk about the Class 8 sector from a total North America perspective in a lot more detail after me, but this just looks at the U.S. tractor market, which I kind of think is the core of the U.S. trucking industry. And it looks at the supply. And so over time, essentially the way we build this model is just estimating the entire population. We use mortality curves over time, and we essentially say that after 15 years, the vehicles are out of the active population. And so what we can see right now is that there's a decent growth rate in capacity, but it's just starting to accelerate. And so as we go into 2019, we are right here in terms of that capacity going from slow growth to a little bit faster growth. And so we think that we'll go from roughly 1.6, 1.7 million, up, call it about 50,000 units in that North America Class 8 population over the next year or so. So I think that's an important factor. The key message here is we do expect a slowdown in freight volumes, and we do expect an acceleration in new tractors entering the U.S. population. So I think this chart is really important just in terms of sort of explaining where we are in supply and demand. The green line here shows our first sort of freight forecast, and this is for the truckload market. And the factors I described earlier, the flattening yield curve and potentially a little bit slower inventory growth are going to put some downward pressure on this. And also it's the tougher comps from the hurricanes last year that suggest that rail volumes are going to slow as well. So all that adds up to freight slowing from the 5 or 6% growth rates that we've seen this year down to a low single-digit growth for 2019. And so I think that's going to take some pressure off of the system overall. And I think that it's still a fairly positive environment. I don't expect freight to turn negative anytime soon, although I will point out, in all this discussion of backlogs lengthening, I spoke with the CFO of one of the truckload carriers just the other day who said, just to remind you, this is not a backlog business. Freight could fall off tomorrow. I don't think it is, but it's an important point to make. So this next slide takes what I just showed you with supply and demand, and instead of, as we had the line here is just the volume index for ATA loads. The line on this chart is supply minus demand. So basically what we did was we took the amount of freight growth, and then we subtracted the amount of capacity growth, and then we just did that by taking the number of net new tractors as a percentage of the population and annualizing that. And so we subtracted the two, and so this is more of a supply-demand balance, which I think is very interesting as you compare the two charts. Every time the supply-demand balance goes to a super tight level, you get a jump in rates, and every time we go to a super loose level, you get a drop in rates, and there's a 6 to 9 month lag. So what we're seeing now is we've had a very tight environment where we've had strong tonnage, and the growth in tractors has actually been negative. That's going back to last year. We're currently seeing this acceleration in production, and we're just nearing the inflection point where supply and demand are going to get more balanced. And what this tells us is that by sort of mid to end of 2019, we'll actually be in a slightly negative position overall. And so that pendulum is going to start shifting from the truckload carriers back to the shippers in terms of pricing power. And that's why we've got this on the bottom chart. We're forecasting rates to slow down pretty sharply throughout the course of 2019. Although it is important to point out, these are the best rate increases on record. So we're still in an excellent pricing environment. I think I would take a little bit of a more cautious view than some of the more positive truckload executives who are calling for 5 to 10% contract rate increases again next year. I think that's a little on the aggressive side. I think things are still going to be positive, but I think we're going to be in the transition phase of moving back towards a tougher environment for truckload through the course of next year. So here's another DAT chart. I think this is one of the most important ones, and just shows that this slowdown actually is already starting in the spot market. And we also spend a lot of time trying to understand where the spot market's going, obviously, as it's a great leading indicator. So we've seen a deceleration from the low 30s to the low 20% increases in the spot market, but where do we think it's going? We developed this leading indicator several months ago at this point, and actually we presented the first time at our last seminar. It's working really well. Basically, I know this is not the easiest chart to look at, but the red line is the leading indicator, and it's derived from our survey data that I showed you earlier. It's a very volatile number, and it's designed really to tell us more about the direction than the actual magnitude of what's happening. The 3-month moving average is the black line, and that tends to be a good leading indicator, about 2 to 3 months with a very strong correlation ahead of this, the DAT data, which is the blue line. So what this tells us is that we're going from this low to mid 20s in terms of year-over-year increases in rates, probably down to the mid to low teens over the next couple of months. And comparisons continue to get tougher as we start facing these comparisons over the next several months. And so I do think the trend is just almost fated to slow down to more of a zero type of a level. Sorry, let's go back here. So I think it's going to be in the high single digits in the fourth quarter. And the first time when I think there's real risk that we see negative year-over-year rates is probably January and February of 2019. In January, February of this year, if you remember, we had that really cold weather. It tightened up the rail network and really tightened up the truckload spot market. So that's going to be a really difficult environment to compare against as we look at next year. Here is the current profitability outlook for the major truckload carriers. This is the 13 carriers that are in our carrier database. They posted the best improvement, as I talked about a little earlier, in margins that I've ever seen in this last quarter. Margins went up about 230 basis points on a net margin basis to a roughly 6% profit margin, and we think that's heading towards 7 over the next few quarters. And the reason that I think that profitability is going to continue to improve at least through the middle of 2019, despite being a little cautious on the spot market, is that the contracts that were just signed in the second quarter of this past year were signed with those record rate increases that I talked to earlier. If I actually go back to that, these contracts, these contract rates that we've locked in here are essentially locked in through the middle of next year, unless you see any major shocks, which we're not expecting. So, coming back to this on the bottom part here, we show it on an annual basis, and so this year is shaping up to be one of the best, but not necessarily the best, and that's despite the tax cuts. So some of the increase, about half of the increase in margins that we're expecting on a net basis is coming just from a lower tax rate. It's only about 100 basis points on an operating basis. So the industry still has a good amount of room to improve to get back to record operating margins. And we do think that that's likely to happen in 2019. But I think 2020, as we start to think about the slower volume and the faster capacity growth, I think in 2020 that's more likely to drive a decline in truckload pricing. So that is our current, our initial freight forecast. And we are going to be putting this into a more complete report in the coming months and expanding this to talk about LTL and a little bit of parcel and intermodal and so the tangential modes to truckload. But in terms of the 2019 balance, we do think the major risk, again, is the trade war, which I mean, on the downside, could drive rates to a negative territory even sooner than we expect. And on the upside, if this industrial cycle and consumer cycle continues and we do have this pause that refreshes and the economy continues to run for a few years, I don't think the 5 to 10% rating increases in 2019 is that unrealistic if you see continued strength in freight. So those are sort of the parameters around the forecast. And I'll also point out that we did just upgrade our truckload carrier database, and we will have an LTL one out pretty soon as well. So for those of you who like the financial data, there's more of that coming from us. So with that, I have 3 minutes for questions. Any questions? In the back? You can stand up and shout. Yep. Yep.
You have drug and alcohol database coming out in 2020.
Yep.
And you have the proposals for hair follicle testing. I mean, couldn't all these be reasons why to maybe mention what the previous panel said could be different this time?
Yes, yes. I would throw tax cuts into the mix of that as well as like what's different this time is that the economy's got a little extra fuel because of that. Yes, you're definitely right, Brad. And so one of the things that this doesn't do a wonderful job of is predict magnitude. I think our first job is to make sure that we get the trend right. But this little decline here, in reality, was a lot bigger. So we were taking a few trucks out back in 2017, but because of the ELD mandate, capacity tightened materially further than that. And so the record spike in rates, I think you're exactly right, was more driven by the regulations than the supply and demand balance. The supply and demand balance was still an important piece of it, but I'm not arguing that this tells you 100% of the picture. Any other questions?
Just a comment, if I might. Tim has been working on our truckload database and made several major improvements. For those of you in the audience aren't familiar, go on our website, and Tim is also expanding the database to have both truckload and less than truckload. So it's going to, and you have all the data and everything available, become quite a good analytical tool for those of you who do that type of analysis.
Exactly. Thank you very much. And next up,